This is a hypothetical geopolitical analysis created for educational and documentary purposes. The scenario you are about to hear is not real breaking news, but a forward-looking examination of what could happen if global tensions escalated dramatically. Tonight on Crisis Clips, a sudden military mobilization, oil markets on edge, defense stocks surging, and the global economy bracing for impact. If Operation Epic Fury were to unfold in the next 48 hours, what would it mean for your investments, your retirement portfolio, and the price you pay at the pump? The world economy in 2026 is tightly interconnected, fragile in places, resilient in others. Global supply chains are still recalibrating from pandemic aftershocks. Energy markets remain highly sensitive to geopolitical signals. Central banks are navigating a narrow corridor between inflation control and recession risks. Against this backdrop, analysts inside Washington policy circles and global investment banks have quietly modeled a hypothetical scenario, now referred to as Operation Epic Fury, a rapid military escalation involving major powers and critical energy transit corridors. In this scenario, tensions intensify in a strategically vital maritime region responsible for nearly 1/5 of global oil shipments. Naval exercises expand. Airspace restrictions widen. Satellite imagery reveals accelerated military deployments. Insurance premiums for commercial shipping jump within hours. While no formal declaration of war is issued, markets interpret the signals immediately. The situation moves from diplomatic strain to visible military readiness in less than 2 days. In the first 24 hours of this hypothetical escalation, global oil futures react sharply. Brent crude spikes 12% overnight. West Texas Intermediate follows closely behind. Energy traders price in the risk of supply disruption, even before any physical interruption occurs. Hedge funds increase long positions in crude. Airlines begin hedging fuel exposure. Refiners scramble to assess inventory levels. By hour 36, energy importing nations in Europe and Asia issue statements urging de-escalation. Strategic petroleum reserves become a topic of discussion. Commodity volatility spills into currency markets. The US dollar strengthens temporarily as investors seek perceived safety, while emerging market currencies weaken under capital outflows. Now consider the stock market reaction. In this scenario, the Dow Jones Industrial Average opens down 800 points on day one, reflecting uncertainty and algorithmic sell-offs. The S&P 500 drops sharply in early trading before stabilizing. The Nasdaq faces pressure, particularly in sectors dependent on global supply chains, semiconductors, consumer electronics, automotive manufacturing. At the same time, defense contractors experience a surge in investor interest. Shares of Lockheed Martin, Northrop Grumman, Raytheon Technologies, and General Dynamics move higher, as markets anticipate increased government contracts and accelerated procurement programs. Exchange-traded funds focused on aerospace and defense outperform the broader market. Treasury yields fall initially as investors move toward safe haven assets, pushing bond prices up. Gold prices climb. Volatility indices spike to levels not seen since previous global crises. Retirement portfolios, particularly those heavily weighted in equities, experience immediate paper losses, though defensive sectors cushion some of the blow. But the deeper impact unfolds beyond Wall Street. Oil markets are the backbone of this scenario. A prolonged disruption in a key shipping route would tighten global supply chains rapidly. Even without a complete blockade, the perception of risk can drive prices significantly higher. If Brent crude were to move above $110 per barrel and remain elevated, gasoline prices across the United States could rise by 40 to 70 cents per gallon within weeks. For American households, that shift is not theoretical. The average U.S. family spends thousands annually on fuel. A sustained spike would ripple outward, raising transportation costs for goods, increasing airline ticket prices, pressuring food supply chains, and potentially reversing recent progress on inflation. The Federal Reserve, already balancing inflation targets with growth concerns, would face renewed pressure. Higher energy costs translate directly into headline inflation. Policymakers would confront a difficult choice: tighten monetary policy to control inflation, risking economic slowdown, or tolerate higher prices to preserve growth. Defense spending implications are equally significant. In this scenario, Congress responds swiftly. Supplemental defense appropriations are introduced, multi-year procurement contracts are accelerated. Investments in missile defense systems, cyber capabilities, naval assets, and next-generation aircraft expand. The defense budget, already measured in the hundreds of billions, could see an additional surge. That spending stimulates certain sectors of the economy. Manufacturing jobs tied to defense supply chains may increase. Research and development funding grows. However, federal deficits also widen. Bond markets begin pricing in higher long-term borrowing requirements. Fiscal hawks warn about sustainability. Global trade disruption compounds the economic impact. Container shipping rates rise as insurers reprice risk. Major ports experience congestion. Technology manufacturers dependent on cross-border components face delays. Automotive production lines pause due to shortages of critical parts. Agricultural exports slow as shipping capacity is for everyday Americans. The scenario becomes personal quickly. Consider Michael Thompson, a 52-year-old logistics manager in Ohio. His company depends on imported components routed through global shipping lanes. Within a week of heightened tensions, freight costs jump. His employer freezes new hiring. Fuel surcharges appear on delivery contracts. Michael watches his 401k fluctuate daily. He wonders whether to adjust his retirement allocation. At the gas station, he notices prices climbing steadily, even before any official supply disruption occurs. His story reflects a broader reality. Geopolitical risk is no longer distant. It translates into grocery bills, energy costs, mortgage rates, and portfolio performance. Technology markets would also face secondary consequences. Semiconductor firms reliant on global fabrication networks could experience shipment delays. Consumer electronics prices might edge upward. Retailers adjust inventory forecasts for the holiday season. Investors reassess growth projections for multinational corporations. Currency markets would remain volatile. A stronger dollar may provide temporary relief by moderating some import costs. But it also pressures us exporters. Trade deficits widen. Multinational earnings reports begin reflecting foreign exchange headwinds. Insurance markets represent another critical pressure point. War risk premiums for maritime transport rise sharply. Energy companies reassess exposure. Aviation insurers update coverage terms. Those additional costs filter through supply chains, embedding higher prices into everyday goods. If the escalation continues beyond 48 hours into weeks, central banks coordinate emergency liquidity measures. Strategic petroleum reserves may be partially released to stabilize markets. Diplomatic backchannels intensify. Markets oscillate between optimism and fear with each new headline. Historically, markets have demonstrated resilience after geopolitical shocks. Yet each event leaves structural changes behind. Supply chains diversify. Energy policies accelerate transitions toward renewables and domestic production. Governments reassess defense readiness. Investors adjust risk models permanently. Operation Epic Fury, in this hypothetical construct, represents more than a military scenario. It becomes an economic stress test for globalization itself. It reveals how interconnected financial systems respond under pressure. It underscores how rapidly confidence, the invisible driver of markets, can shift. For us consumers over the age of 35, homeowners, parents, retirement savers, the key questions center on stability. How secure are energy supplies? How diversified are investment portfolios? How resilient are job markets tied to global trade? Defense spending may stimulate certain industries, but broader inflationary pressures could erode purchasing power. Oil price volatility could complicate monetary policy. Global trade disruptions could slow growth in key sectors. In the end, the outcome would depend less on initial military movements and more on diplomatic resolution speed. Markets crave predictability. The longer uncertainty persists, the greater the economic cost. As we close this analysis on Crisis Clips, One question remains: in a world where a single flashpoint can move trillions of dollars in hours, are global markets truly prepared for the next 48 hours of uncertainty? And are American households ready for the economic shockwaves that could follow? Stay informed, stay prepared, and we'll continue analyzing the forces shaping the global economy.